Welcome everybody. Welcome all of you to the SELAR-Room. We're going to be having an interesting topic today. We're actually delving into what we all specialize in, and that's real estate. And so, intros.
Bryce Ramsey, insurance agent.
Susan Ramirez, sales executive at a title company.
Daniel Johnson, real estate.
Willie Davis, loan officer, 243-6684.
Oh, we're on it today.
Oh, man.
That's how you know it's serious.
Oh, man.
Numbers come out, that means we're serious about what we're doing. All right, so we got a fun, interesting topic. I think we're going to get a lot of views on this one. But first, let's go to the events.
Awesome.
What's coming up for this weekend?
So,
You want south to north? You want to go
let's start
first?
north to south.
Okay, we'll go down. In Austin, we got a couple music things going on. We have Steve Aoki is coming on the 5th, Friday. He'll be at the Concourse Project. And a couple days after, on that Sunday, the 7th, is the CMT Music Awards, which is returning to Austin. I think they had it a couple years ago there, and it's coming back. So that'll be a lot of fun.
Awesome. In San Antonio, we have a unique dining in the dark experience, and you dine blindfolded. It is at the Pearl at Botica. It's $64 a person.
It's a lot for some shadows.
Yeah.
I'm thinking about a movie that came out down and blindfolded too. It didn't go so well. Let's put it that way.
You just don't know what you're putting in your mouth.
This is Peruvian Asian fusion
Yes,
restaurant.
yes.
All right, Willie, what you got?
I have an air show that's happening. This is going on the 6th and 7th. Y'all know this is my favorite because I'm a vet myself. But
Thank
at
you for your
Randolph Air
service.
Force Base, no problem. No problem.
Thank
Happy to have done it. Yes, of course. It wasn't always pleasant, but it was well worth it. It was great. Everybody did things for me. So, but it's going to be awesome. It's going to be a great time. It's going on 2 days for the public. It's going on for 4 days for the service members and those with IDs, military IDs. So, good time. Make sure you make it out there. Come see some cool planes, cool stunts, and things like that.
Cool. And then the one big one we all have, from Austin down to San Antonio, is the eclipse.
You thought dying in the dark was Now you'll live in the dark.
I hear it's going to be a cloudy day, but I also heard stories about another eclipse that happened in the United States, and they say that right before the eclipse happened, the clouds kind of separated because there wasn't the sun to hold all the rainwater in the cloud. So we'll see. We'll see what happens. But one way or another, the sky's going to get dark during the day. That'll be interesting.
Nice.
Now that that's completed, we have our weekend taken care of.
Mm-hmm.
This is a topic that I think is going to get a lot of buzz. This happened in the past, and people would go crazy when they could get this kind of deal. And now, I don't know that it's such a deal anymore. We're going to talk about assumable loans.
Assumable loans.
Assumable loans.
Assumable
So,
loans.
what is an assumable loan?
Let's see. So let me start off by saying this. When you deal with an assumable loan, you're not dealing with somebody from my profession. You're dealing with somebody that is, I won't say it's somebody from my profession, but you're not dealing with me. You're going to be dealing directly with the servicer. And the reason why is because we originate loans, but they're the ones that handle the loan after we originate it. So you won't be going through a person like me.
Okay.
But an assumable loan is basically exactly what it says. You're going to be assuming the loan at the rate and basically the time and place where that loan is that the seller has it when you assume the loan. So, for example, if you had a seller that had a 2 or 3% interest rate at 15 years into a mortgage, right?
Mm-hmm.
You would now, if you could qualify and come up with the equity and everything else, you would assume that loan at that 2% or 2% interest rate, 2 or 3% interest rate at that 15-year moment.
Oh, wow. That sounds like it could be a good deal.
It could be.
So how do I qualify for an assumable loan?
So you qualify for it similar to how we would qualify for a regular loan, I would imagine. But it is basically your income, assets, and your debts, right? So what you're gonna need is your W-2s, your bank statements, and your pay stubs, and along with your, or taxes, depending on what you have, right? Because some people are self-employed or business owners, so they don't usually get pay stubs, of course, right? And then you need your other documentation like your Social Security and your driver's license.
Now I know, Daniel, you said that this was a great deal in the past, but why would this maybe not be, or maybe could be, a good deal in today's market? What's kind of the time factors of that? What other y'all say?
As far as it being a great deal,
Yeah, like why would someone want to do an assumable loan versus not, and why might it not be as popular in today's market compared to back then, or vice versa?
no, I can answer that.
Situations beyond that.
So when you start talking about assumable loan, the pros to assumable loans that, like I said before, you're going to be getting that rate. You're talking about right now, most people are getting 6 or 7% interest rates, right? So when you look at somebody that has a 3% interest rate, I mean, that's a lot of savings in that if you can afford the savings, right? And that's where the con comes in, right? The other pro to it is that you're also getting it at that point in time, right? And you don't have to pay as many lender fees as you would necessarily because you're not dealing with it. You just have to pay for the servicer's fees and whatever they offer, right? So the cons to that is that the equity, man. You gotta cover the equity. If you don't have enough money to cover the down payment, the equity that's needed, then it's gonna be hard to afford that. And we're not talking about your typical 3 to 5%. You're talking about a good amount of whatever that person put in there plus the appreciation of that house. So most people don't have that kind of money just laying around. We're talking about anywhere from, 50,000 if it's like a quick one, but if you're talking about somebody that's in there, then you could be paying upwards near like in $100,000 range.
So we know that interest rates, and we won't quote any interest rates right now, because that's just not something we're gonna do for everybody. But interest rates in the 2, even 3 years ago were ranging from 2 to 5% for anybody getting a loan. So there's some people who might be able to get a 2 to 5% on a loan if they pay for somebody else's equity. But the question becomes, does there need to be a clause stating your loan is an assumable loan?
Yes, there is.
Oh,
So you can find this on the closing documents, the seller's closing documents. It'll say something to the effect of that this loan is assumable, basically. And that's how you can tell if your loan is assumable or not. Typically, what you will see are VA loans and FHA loans will have this clause, but where you won't see it is conventional. The reason why is because there's a due on sale clause.
Okay. Can I take out a loan to assume a loan?
That is a question that you would have to get with the servicer on.
Okay.
Okay, and the reason why is because they're the ones that ultimately are going to qualify you for this type of loan. Typically, in a normal loan situation, the way that you would be able to do that is if you took out a secured loan, right?
okay.
So the example of this would be if you had a car that was paid off completely, right? Didn't have any liens against it or nothing, right? You take out a loan against that vehicle. Now you have funds, right, to afford the down payment. Now the downside about this is that we still would have to use that loan that you took out against your liabilities.
Okay,
Okay.
okay. So
So
that's
it's still be
factored in.
factored into the equation of your DTI.
Checks out.
So then, speaking about DTI, and people paying things back, sometimes people end up in bad situations where they may get behind, and so they may end up in a foreclosure situation. Is there a better chance of assuming a loan if it is in foreclosure?
So we're talking about a foreclosure.
Right.
So the person was already basically behind in their payments. Their home is in default, right?
Yeah.
So I couldn't imagine that somebody or a bank or the servicer, right, who just took this home back would be willing to allow somebody to assume a loan, right? That would be something you have to get with the servicer on because every situation is unique, right?
It is.
So it's not a one-size-fits-all kind of thing.
Mm-hmm.
But I just couldn't imagine it only because of why would I, as the servicer, if that were me, right, give you a 2% rate on a home when I could have somebody else come in and take it at 6%.
Yeah, I could see a 6% working out well. You bring up a really interesting point because it's almost like banks competing against each other because.
Well, the thing about it is I'm talking about, say for instance, you want to assume the loan from me.
Yeah.
Right? And she also wants this home, right? She wants this home that's going into foreclosure.
Let's call it $200,000.
Right, $200,000, right?
Okay.
Now, what you're asking is that you want me to basically, you want to assume the loan with the forbearance, right? Or not forbearance, but basically assume the loan at 2%, right? With $200,000, why would I give you that when I can give her for 6. She's willing to come up and pay 6%, and basically take over the loan or start a brand new loan on it. I'm going with her because I'm gonna make more money off of it as the servicer of that loan.
I just know that in foreclosures, sometimes banks agree to take a lesser amount than is due on the loan. And so that might be a situation, and who knows, it might be a situation where the bank looks at it and says, you know what, we're gonna make more money by letting somebody assume the loan and having them pay it off with good credit, rather than losing money on the loan altogether.
It could be, and that's the reason why I said every situation is unique,
Yeah.
right? So you would have to call your servicer,
Yeah,
the servicer of that loan, and see if they would be willing to take that.
that would be really interesting, to throw the whole industry on its head and say, hey, we're not gonna do foreclosure, we're gonna do assume the loan
Mhm.
instead. That's a interesting thought. So if you had a small business, does that affect things?
It does affect things.
Okay.
Everything depends on, when you start talking about businesses, right? The question becomes, it's a lot of questions that come with it. How are you filing your taxes is the biggest one, right? And are you taking losses? Are you getting gains, right? Just because a person may be a business owner doesn't mean that they're necessarily going to be a shoo-in for a loan, right? Or an assumable. Because if your business is taking hits, well, it's going to be a rough one. You may have some trouble trying to qualify. So, but if you're getting gains, it could be good. But then again, if you have gains, and say that you are taking a lot of what they call exemptions, right?
Mm-hmm.
You're removing things off, right? Well, if you look at your income that you're filing in with the state and the federal government, right?
Yeah.
And it's not enough income to support you for the year, even though you be making like, let's say $250,000 a year, right? Which is plenty to qualify for a home, right?
Yeah.
If you're not claiming that, without
That
exemptions
income.
and stuff like that on the income, then you won't qualify, because we can only go off of what's showing on your taxes on your income.
So every situation is going to be different.
Every situation is
There's
different.
no two that are gonna be like, this is
Nope.
easy.
Right,
No such
exactly.
thing as
No,
Is anything easy today?
it's very situational. So it's one of those things that's not a one size fits all, or this one person, this type of borrower is a perfect borrower. It really depends, because if things could seem like they're a shoo-in, but depending on how it is when we look at it and we review the file, that's when we can determine like, yeah, they're gonna need a little bit more funds or whatever the case may be, depending on that particular loan that we're looking at.
Now, Willie,
Mm.
speaking on the different types and situations and things like that, say it's a VA assumable loan,
Mhm.
can someone non-military take over that? Or what would that
Good
fall
question, because I'm a vet, right? I like that kind of
Our
kind of made me step up a little bit, but yes, they can. So, but here's the tricky part to it, right? When you start talking about assuming a VA loan for a non-VA lender, right? They are assuming that person's entitlement, right? And what that means is that VA borrower now has less entitlement when they go to purchase their next home. So, say for instance, that could work against them if they were moved from a place that may not be so expensive, like New Mexico or South Carolina or something like that, right?
Okay.
Say they move to California where houses are super expensive, right?
Yeah.
If you don't have enough entitlement to cover that house or the cost difference, well, they have to come out of pocket with the difference. So every veteran isn't really up to par with losing their VA benefit to help somebody that honestly is not, really affecting them. Now, every situation is different, right? If they were like in a desperate situation, maybe, or it worked out well for them, and they had enough entitlement, then maybe yes. But that's a hard one to swing because you're gonna be dealing with that actual, the seller on that.
Okay.
nice.
So, is there an effect on anything else regarding assumable loans? Like, as an example, does title see anything different when?
No, what title does is we clear the homeowner and the property, making sure there's no liens against any. So for us, we work in exactly the same way. It's just they generally do take longer.
Okay. So That's a good question. What is the time frame people should be thinking about?
That is a very good question that I haven't answered you. So you're
Okay.
looking at about 60 to 90 days. So if you're doing an assumable loan, you want to plan out and make sure you have the time frame. This isn't the type of loan that you want to be trying to rush for a last minute. I need to hurry up and get to this home because I'm trying to get out of my apartment. This is going to take some time. So typically they don't work as fast as like a normal loan.
Yeah, I've seen a lot of people post lately that they're taking anywhere from like 120 days and beyond. Every place is going to be different, but
Yes.
that's why they say you have to be patient when dealing with that type of loan.
Yeah.
How about on the insurance side of things?
Insurance, we don't really care. The only situation where really that does affect insurance stuff is kind of what you were talking about earlier. If they're paying a lot of equity out of pocket when assuming a loan, that can create a lot of DTI situations potentially, where the insurance is a big factor of that DTI. And so for me and my job, it really comes down to if someone has to get something below a specific number, they might have to sacrifice certain coverages on insurance or have to work things around just in a way to get it below what number would meet the DTI for them to assume that loan. They should just be aware that when they're taking on that responsibility, that insurance could look a little bit different maybe than what they're usually looking at, just if that does create a DTI. But outside of that, it's the same as writing a regular homeowner's policy. So.
And for those of you that don't know what DTI is, we are talking about your debt to your income. So how much money you make versus how much money you have on your credit that's showing.
Is it okay to have it flip-flopped?
Where what?
Where income's here and debt's
I would love to see it down here. You know, those are great situations.
Income's here, debt is here,
What
then you
about
buy a
the
home,
other
and then all of a sudden.
Exactly, right? So here's another thing too that's very interesting, right? When you start talking about an assumable loan, right? We're talking about it from a buyer's perspective right now, but on this and a little bit from the sellers. Another thing for the seller to consider too is that they have to have a release of liability. Okay, there's a very important document to have because God forbid you know this person assumes a loan, they default.
Oh,
It's
yeah.
still under you, right? Especially as a veteran borrower, you know, because now your VA loan's on the line because of something that you had no part in. So you need to make sure that you get that release of liability so that way you're not held liable for the actions of another that honestly you have nothing to do with.
Also, Susan, you got some paper
Oh,
there
yeah.
to explain
So-
what that's
Love
for?
paper.
Loan. When you sign and you have a loan, this is about how thick you're signing at closing, right?
Get your signing hand ready.
This is a sign of all the work everyone has done.
This is it. Now, if you have cash, bam, baby. It can even be a little smaller than this.
Ooh.
So that's why they always say cash is king.
Cash is king.
So yeah, there you have it. If you're signing with the loan, get ready. Because people come in and they're like, "You're signing my life." Yes, you are. It's one of the biggest purchases you'll make in your lifetime.
Yes.
And so, yes.
But if you don't have cash, I'm right here for you.
We can absolutely make it work. And then finding an assumable, a house with an assumable loan, practically any house that's up for sale with a loan on it potentially has an assumable loan, unless
Unless it is a conventional loan.
and so you have to watch out for that kind of thing. If you're looking in Austin, San Antonio, the Brownfields, anywhere on the 35 in between, give any one of us a call and we can point you in the right direction to get your answers taken care of and to help you become part of our community. Thank you for coming to the SELAR-Room, and just remember to
Like.
Comment.
Share.
subscribe.
We'll see you next time.